global synchronous growth in 2017 turned into divergent growth, right? The U.S. versus everyone else, and has now turned into what you call a synchronous slowdown. Is it synchronous, or is it being driven by Europe, driven by China?
Well, I think it's synchronous because the global economy is connected. And certainly China and Europe are pulling down on the United States. But, at the same time, we've seen the impact of rising interest rates. Even though we've had, a really large decline from December, housing activity slowed dramatically in the United States in the second half of the year. And so, we're getting it from all sides, both internationally and domestically.
We saw certainly some of the trade numbers reflecting that in the United States. But generally, many feel that the US is somewhat isolated from the rest of the world when it comes to concerns. It's more the politics at play here. How worried are you perhaps by tensions between China and the US when it comes from a trade perspective, once again, front and center today?
Well, I'm a lot less concerned than I was, let's say, 2 months ago. And I think the reason is that the administration's got a clear message after the market rout that we just went through, that we could actually do damage to the expansion if we don't get a deal done with China. So I think that the White House in particular is very focused on making sure some kind of a deal happens. Now, I don't know that that means that we're going to cut the tariffs by March the 1st, but I think the administration would be loath to escalate tensions right now, especially given the fragility in the markets.
When you look at how global central banks are responding to the fragility, certainly it's being led by the Fed, which took a dovish turn here last week. At the January FOMC meeting, our Michael McKee asked, I think, what was the critical question. He asked, is it fair to characterize what happened at that meeting as not a pause in a tightening cycle, but the end of a tightening cycle, a new regime for the Fed?
Well,
what's your take?
Well, it's interesting. I right after the December meeting, which I was here for, I made the comment that the likelihood of a rate cut this year would be 50-50. And sure enough, today as we sit here, the market is pricing actually at this moment for a modest rate cut. And if you look at the yield on the 5-year Treasury note versus the 2-year Treasury note, it's actually lower. So the market is priced at this moment for a modest ease. Again, I would say it's 50-50. I think that the Federal Reserve would like to get back on track after maybe a prolonged pause of 6 to 9 months of raising rates again. But on the other hand, if there's more pressure from overseas, as they mentioned in their statement, they're going to react to that if necessary.
Overall, we've heard the word recession put well on the back burner, it feels, ever since particularly the Fed really started to show that it's got some patience. But I heard it once again from Jim O'Neill of Goldman Sachs fame, of BRICS fame. He coined that term. He's looking at other things, looking at China, looking at South Korean data. From your perspective, is a recession any time soon? Well,
originally before the December meeting, I thought the recession would come probably early 2000. Now, based on the pause, I think that we probably have pushed it into the second half of, 2010, 20, whatever year this is. And I think we pushed it into the last half of 2020, maybe even into 2021.
Interesting.
So I think our recession risks here in the United States have declined significantly. But overseas, Germany, Italy, potentially Japan. China can't afford a recession, and Xi Jinping made that clear.
It won't make it happen.
Right. They will not allow it to happen.